what I wanted to do is just kind of talk about a couple of the offerings that we've done recently, just to kind of give an update. We've worked with a lot of white coat investors over the last few years. And so I just want to kind of give a brief update on a few deals that we did with everyone. Urban Landing was a deal that we started last year. And that was a value add deal that was two assets. One is, we started in fall of last year. The construction on the first one is completed, and the construction on the second one is underway. We have a target exit in 2026. Distribution just started this past quarter, which we're really happy about. There's a small chart here on the left, lower left-hand side, which talks about just general initial rents when we purchased the assets versus where they are now. We did a pretty good job, I would say, with the construction team to really kind of knock this out in about 4 to 5 months for the full construction gut rehab of a building, get it fully leased up. We beat our numbers, and the increase in revenue was about 157%. And the market value of the building went from about 2.35 to roughly 5.3. So we're really pleased with that. And we'll look for an exit next year on that. 319 Prospect is another deal we did with some white coat investors. This was a ground up project in Prospect Heights in Brooklyn, which is also completed. 6 of the 8 units have sold. This is about an $18 million sellout in total. The first investor group exit has been completed, so they were happy. They did a nice job on the returns on that deal. And then the second group is going to exit in Q2 of 2025. So next, by spring, we're hoping to be done and close that one out. And then Hudson UpG is one we're starting up now, which is very similar to Urban Landing, a portfolio of assets. That's a bit of a syndicated fund model that we'll buy in Williamsburg and Greenpoint, Brooklyn, where we'll reposition and sell the assets over a 30-month term. And we'll have first distributions targeted for early 2026. And in general, Urban Landing and Hudson are very similar to these type of assets, which is 203 Richardson, and another one we'll show right after this, which is 95 Diamond, where we buy these assets that are these smaller buildings in Brooklyn, where it might cost $2 to $3 million to buy the asset. We'll reposition them, and then we'll exit for about $6 to $8 million, depending on the deal. And what we do is we kind of combine these into small portfolios of assets. And then we build a syndication around them. So that way, when I say it's a bit of a fund syndication hybrid, it's modeled as a syndication, but you're spreading your risk a little bit more than the traditional syndication, where it's deal by deal. You might have 2 or 3 different assets in different neighborhoods, different parts of New York, where you can kind of diversify a bit. And when they all exit around the same time, which is usually about a 30 to 36 month term. And then we sell those assets, and then investors exit from each deal. So Richardson was just like that. And then 95 Diamond here was very similar as well. This one turned out really well. It was a 2.1 purchase price, and then exit for over $7 million. Again, this one being in Greenpoint.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.